Hi, this is Brenna Surette, Wealth Advisor at Bernie Wealth Management, and today I'm joined by Ben Scrivener, another Wealth Advisor on our team. Welcome to Byte Size Retirement, where we take common retirement planning topics and break them down into bite-sized pieces. These videos are not investment or tax advice, but hopefully help remove some mystery and provide a solid foundation to plan off of. And remember that while we're taking just a few minutes to explain these topics, please take more than just a few minutes to make any of these important financial decisions. So today's video is actually a case study walking through someone's first time RMD or first time required minimum distribution. And before we dive into the case specifics, I think it'd be helpful to break down exactly what an RMD even is. So Ben, do you mind explaining just at a high level what an RMD or required minimum distribution is?
Yeah, of course. And a good way to kind of think about it is, in your working career, you're going to be saving money, hopefully toward retirement. And a lot of that is going to be in pre-tax dollars. So whether that's an IRA or 401k, whatever it may be, you're able to build up a pre-tax savings amount. So the government understands that and says, hey, we've allowed you now 40, 45 years of pre-tax savings. We kind of want some of those taxes back. So what they do is they've established a required minimum distribution age, which is currently 72. And in that first year, it's going to be roughly 4% of your account value is what it comes out to be, is your required minimum distribution. And that is going to be all taxable dollars coming to you. And so that's how they're going to get some of that tax money back. There are some penalties involved with around RMDs. It's actually a 50% penalty of any amount that was not satisfied. So if you had a $10,000 RMD for this year, you didn't take it, they're going to say, okay, you owe us now $5,000 on top of what you're supposed to take and the taxes that you paid on that. So it's a pretty hefty fine that we want to watch out for, but we wanted to make sure we cover that before we kind of jump into our case study today.
Yeah, definitely. Thanks, Ben. Again, just to drive that home, if you do not take your RMD, you're going to be hit with that 50% hefty penalty, which is why we want to make sure that we give a really clear understanding of what an RMD is. And two, I know that especially if you are approaching age 72, you might be seeing RMD or required minimum distribution sort of looming around, and there might be some confusion. So hopefully with this case, we'll be able to give you an actual example and some visuals to get a better understanding of what that will really feel like once you hit age 72 and do need to start taking those distributions. So I'll start out actually giving some context around the case that we'll be walking through. So we've got Justin and Jennifer. Justin is currently age 71, but will be turning age 72 next year. Jennifer's still got a little bit of time. She's age 68, but in a few years, she'll also need to be taking her required minimum distribution. Both are retired, have been retired for about 5 years, and they are receiving income through Social Security and pension. So roughly $48,000 in Social Security income, and then Jennifer is receiving $15,000 in pension income. So next up, we can go ahead and look at a 5-year cash flow. So looking at a sort of a smaller window, and just to give, again, some context here, we've got this year all the way through 2026. We've broken it out into portfolio assets, cash inflows, and cash outflows. So we'll start out by actually looking right in cash inflows, primarily focused on planned distributions. So these will be distributions coming from, like Ben mentioned earlier, those qualified retirement accounts that have been growing pre-tax, and now they will need to start those RMDs. So in year 2023, next year, when Justin is going to turn 72, you'll see a jump in distributions here. So, 2022 didn't have to take anything out of those accounts, now taking his RMD of roughly $32,000. And then in a few years after that, we'll see the next spike will be Jennifer's RMD kicking in 2025 when she turns 72, bumping up those planned distributions again to $53,000.
And this is a good time to kind of take a look at, those numbers. While we are just looking at numbers on the screen here, there is a pretty significant jump that we want to focus on, where in 2022, that planned distribution number is 0. And they're adding roughly $32,000, a little over, to their income bucket. That again is an all taxable money. So how that affects kind of the bottom line of taxes, which is something we'll also get into later on. But that's just something we want to kind of focus on, a big piece of there.
Yeah, and two, thinking on this on an annual basis and trying to put yourself in Justin and Jennifer's shoes. Again, they've been retired for 5 years now. They've gotten a pretty good pulse on what their income looks and feels like.
Yeah.
And these spikes in income are going to be a little jarring if they're not properly prepared for them. So it will feel different. And I think that's where the prep comes into play, where you can project what those RMDs will look like and how it'll impact your tax situation, which, like Ben mentioned, we'll kind of jump into. And with that, we can actually move on down to cash outflows, specifically looking at those taxes. And you'll see in the same years that those RMDs kick in, which is 2023 and 2025. Again, same as with the income, your taxes are going to go up as well, and there'll be some jumps there. And we'll actually take a deeper dive. I think this is a good time to jump into more specific tax projections. So Ben, I'll actually pass it off to you if you want to just sort of walk through what we're looking at here.
Yeah. So in those first years of the 5-year cash flow we just looked at, that was the first big jump, right? So before Justin was taking his RMD in the current year to next year, where his first RMD is required. So kind of jumping on this list, on the left side in scenario 1, we have that 2022, which would be the year where he does not take it, versus what's going to happen when he has to take it next year. So going down kind of on that mix, we can kind of see the left side versus the right side, and then the green parts in the middle are going to be the big difference makers there. So obviously the big one's going to be IRA distributions, because it's going to go from 0, and we're going to be adding $32,266 of income there. How that really affects it is, if we look down at the bottom of this section here towards this taxable Social Security, you can see that last year their taxable Social Security was just under $15,000, and all of a sudden now there's a $25,000, almost $26,000 jump. So Brenna and I actually done a video previously that talked about how Social Security is taxed, and it's really you're just taking total income, essentially, a combination. It's called your combined income. And depending on how much that is, it puts your Social Security taxability into different brackets. So if you have really low income, almost none of your Social Security is going to be taxable. And then if you have higher income, up to 85% of it's going to be taxable. So you can see that $32,000 of IRA distribution actually pushes them into a much higher level of Social Security taxability. So you can see that there's a pretty big jump there. Taxable Social Security jumping up to the full 85% at $40,800.
Yeah, and we'll make sure to link to that video in the comment section below. So if you want to check that out in more detail, be sure to just click the link in the bio below.
Yeah, absolutely. And kind of going down into scheduled income, just to add a piece of that. So we have obviously the distribution coming in, we have the higher amount of Social Security being taxable. And so it's really bumping up their total income, which is going to go from $45,000 this year, and they're adding almost $58,000 to their total income, right? So that's just kind of a big piece in how we're looking at things, where it's only a $30,000 distribution, but you can see how it really affects other things. So the big thing we want to focus on is total tax, and it's going to be at the bottom here. So last year, you can see that they came to, after withholdings and everything, they ended up owing, and after deductions, I should say, they ended up owing roughly $3,032 in taxes. So again, this is something, as Brenna mentioned earlier, they've been retired for close to 5 years. They're kind of used to that taxable number. And that's what the tax man says at the end of the year. So now all of a sudden next year, they're projected to owe a little over $6,500. They're at $6,800 with a jump of $6,500 to that number. So that's just something that if we're not really prepared and we're not really focusing on, what that means in the long run, that $6,500 jump can really come out of nowhere.
Mm-hmm, definitely. And one question you'll get, if you call into a custodian that's holding an IRA, or you go to make this distribution, probably one of the first questions you'll get is, do you want any withholdings, federal or state? So when you do take this distribution, you will be able to withhold directly from the distribution for taxes. So, as your income is going up, obviously you want to make sure to adjust appropriately. And I think, the follow-up question from that in a lot of cases is, well, how much should I be withholding? There's some question marks popping up. So I think that's a good checkpoint to either connect with a financial advisor or a tax professional to get some guidance, especially if it is your first year RMD, just kind of recalibrating and making sure that you're withholding properly to account for, an increase in taxable income. So one of the first areas that we'll want to look at, not even just in a first RMD year, but just on an annual basis, is, where you fell in terms of your marginal tax bracket. And, going back to that report we just looked at, they were originally in that 10% marginal tax rate, and now they're in that 12% rate. And the jump from, 10 to 12% isn't too drastic, but, the next bump up is from 12 to 22%. So this is a good place to just check in, see how close you are to those thresholds. There may be some planning opportunities if you're, on the edge of one. So always good to check in there. In this case, just looking at the marginal tax rate for capital gains and qualified dividends, same sort of considerations here. They've managed to stay in the 0% marginal rate, but a little closer in terms of the bucket filling up. They're at 74,000, and this next threshold starts at 85,000. So something to be mindful of, especially if they are considering or potentially having any other taxable events for the year. They'll just want to monitor to make sure they're not pushing themselves into another bracket.
Yeah, and that's
and then finally, I know. Oh, go ahead, Ben.
I'm just saying it's a good monitor, because you can see where the income is going to be, the income that's coming in is the same, but it's just, you can see how there's different limits for different things. So whether your marginal tax brackets for income, they're a little bit off from the 22% jump. And then with capital gains and dividends, they're right up against it. And then when we really jump down to the Medicare premiums, that's going to be looking at modified adjusted gross income. So you can see that they're at 103 for the year, and this is going to be pretty much their total income. As RMDs continue to grow, so say those IRA accounts or those 401k accounts continue to grow, and they're just pulling out the minimums each year, that RMD is going to get bigger and bigger because it's going off of last year's portfolio value, so the account value there. So as that continues to grow, RMDs will also continue to grow. So right now, they're not really worrying about having to take care of any adjustments to their Medicare premiums with Part B or D. But you can see that in a couple of years, say that RMD grows, Social Security continues to grow, they could probably hit this $182,000 mark pretty easily, which would put them into the first row of adjustments there. So it's just something, again, we want to be mindful of. And as you can see, kind of the domino effect that income really has on everything. We saw the RMD being 32,000, but that affected Social Security, which made more of that taxable, which drove up total income, which, again, your taxable liability at the end of the year, it can really jump. So, we kind of understand that the domino effect that income has on a portfolio in retirement. And, we kind of want to be mindful for that for all of our clients and for anyone watching this. It's just the big pieces to look at. So I think that's kind of all we had to add today. But, if you guys have any questions at all, feel free to comment below, reach out to us through our website, because, again, a lot of moving parts when it comes to taxes and income in retirement. And we want to be able to help answer any questions we can as they come up for you. So thank you for watching, and we'll see you in the next one.
Thanks.